In the aftermath of the financial crisis, regulators around the world continue to implement reforms that are designed to limit the incidence and severity of future crises. But one area in which we have not yet had reform is that of the regulation of the U.S. operations of large foreign banks. In this area, applicable regulation has changed relatively little in the last decade, despite a significant and rapid transformation of those operations, as foreign banks moved beyond their traditional lending activities to engage in substantial and often complex capital market activities. The crisis revealed the resulting risks to U.S. financial stability. In taking a fresh look at regulation of foreign banks in the United States, I by no means want to imply that the U.S. should revoke its welcome to foreign banks. On the contrary, this reconsideration reflects the important role the foreign banks have played. But just as we are adapting our regulatory approach to U.S. banks, so we need to incorporate important lessons learned from the crisis into our oversight program for foreign banks. The question of how best to regulate foreign banks is hardly a new one, either here or in other countries. Debates over the relative merits of territorial versus global or mutual recognition approaches, the difficulties in achieving strictly equal terms of competition between banks with different home regulatory systems, and the degree to which harmonization of international standards and supervisory consultations can mitigate the resulting inconsistencies and frictions are all familiar topics to academics, to banking lawyers, and to supervisory authorities. While I do not aim this afternoon to resolve the complicated interaction among these perspectives and considerations, I will try to outline a practical and reasonable way forward. Regulating the U.S. operations of foreign banks presents unique challenges. Although we as U.S. supervisors do have full authority over the local operations of foreign banks, we see only a portion of a foreign bank's worldwide activities, and regular access to information on its global activities can be limited. Foreign banks operate under a wide variety of business models and structures that reflect the legal, regulatory, and business climates in the home and host jurisdictions in which they operate. Despite these difficulties, the United States has traditionally accorded foreign banks the same national treatment as domestic banks, and U.S. regulators generally have allowed foreign banks to choose among structures that they believe promote maximum efficiency at the consolidated level. Under the statutory scheme established by Congress, permissible U.S. structures include cross-border branching and direct and indirect subsidiaries, provided that they operate in a safe and sound manner. U.S. law also allows well-managed and well-capitalized foreign banks to conduct a wide range of bank and non-bank activities in the United States under conditions comparable to those applied to U.S. banking organizations. Still, it is worth noting that even as there has been continuity in this basic policy, U.S. regulation of foreign banks has evolved over the years in response to changes in the extent and nature of foreign bank activities. For example, before 1978, foreign bank branches in the United States were licensed and regulated by individual states, with little in the way of federal regulation or restrictions. But the rapid growth of foreign banking in the 1970s, particularly branching, prompted an end to this lighter regulatory regime, as the International Banking Act of 1978 gave the Federal Reserve Board regulatory authority over the domestic operations of foreign banks and significantly equalized regulatory treatment of foreign and domestic firms. A second example is the 1991 law requiring the Federal Reserve to determine that a foreign bank is subject to, and I'm going to put this in quotes, comprehensive supervision or regulation on a consolidated basis, close quote, in its home country before approving an application either to open a branch or to acquire a U.S. subsidiary bank. This statutory change followed the massive fraud uncovered at the Bank of Credit and Commerce International, BCCI, and its subsequent collapse in 1991, which highlighted the need for more effective supervision of banks operating in multiple countries. Although foreign banks expanded steadily in the United States during the 1970s, 80s, and 90s, their activities here posed limited risks to overall U.S. financial stability. Throughout this period, the U.S. operations of foreign banks were largely net recipients of funding from their parents and generally engaged in traditional lending to home country and U.S. clients. U.S. branches and agencies of foreign banks generally held large amounts of cash. Commercial and industrial lending continued to account for a large part of foreign bank branch and agency balance sheets through the 1990s. This profile of foreign bank operations in the United States changed in the run-up to the financial crisis. Reliance on less stable, short-term wholesale funding increased significantly. Many foreign banks shifted from the lending branch model to a funding branch model, in which U.S. branches of foreign banks were borrowing large amounts of U.S. dollars to upstream to their parents. These funding branches went from holding about 40% of foreign bank branch assets in the mid-1990s to holding about 75% of foreign bank branch assets by 2009. Foreign banks as a group moved from a position of receiving funding from their parents on a net basis in 1999 to providing significant funding to non-U.S. affiliates by the mid-2000s, more than $700 billion on a net basis by 2008. A good bit of this short-term funding was used to finance long-term U.S. dollar-denominated project and trade finance around the world. There's also evidence that a significant portion of the dollars raised by European banks in the pre-crisis period ultimately returned to the United States in the form of investments in U.S. securities. Meanwhile, commercial and industrial lending originated by U.S. branches and agencies as a share of their third-party liabilities fell significantly after 2003. In contrast, the U.S. broker-dealer assets of the top 10 foreign banks increased rapidly during the past 15 years, rising from 13% of all foreign bank third-party assets in 1995 to 50% in 2011. The 2007-2008 financial crisis and the continuing financial stress in Europe have revealed financial stability risks associated with the foreign banking model as it has evolved in the United States. To some extent, the concerns associated with foreign banking operations track the more general shortcomings of pre-crisis financial regulation. Internationally agreed minimum capital levels were too low. The quality standards for required capital were too weak. The risk weights assigned to certain asset classes did not reflect their actual risk, and the potential for liquidity strains was seriously underappreciated. But some risks are more closely tied to the specifically international character of certain global banks, both here and in some other parts of the world. The location of capital and liquidity proved critical in the resolution of some firms that failed during the financial crisis. Capital and liquidity were in some cases trapped at the home entity, as in the case of the Icelandic banks and, in our own country, Lehman Brothers. Actions by home country authorities during this period showed that while a foreign bank regulatory regime designed to accommodate centralized management of capital and liquidity can promote efficiency during good times, it also increases the chances of ring fencing by home and host jurisdictions at the moment of a crisis, as local operations come under severe strain and repayment of local creditors is called into question. Resolution regimes and powers remain nationally based, complicating the resolution of firms with large cross-border operations. The large intra-firm cross-border flows that grew rapidly in the years leading up to the crisis also created vulnerabilities. To be fair, the ability to move liquidity freely throughout a banking group may have provided some financial stability benefits during the crisis by enabling banks to respond to localized balance sheet shocks and dysfunctional markets, and by transferring resources from healthier parts of the group. Nonetheless, this model also created a degree of cross-currency funding risk and heavy reliance on swap markets that proved destabilizing. Moreover, foreign banks that relied heavily on short-term US dollar liabilities were forced to sell US dollar assets and reduce lending rapidly when that funding source evaporated, thereby compounding risks to US financial stability. Although the United States did not suffer a destabilizing failure of foreign banks, many rode out the crisis only with the help of extraordinary support from home and host country authorities. Following national treatment practice, the Federal Reserve itself provided substantial discount window access to U.S. branches and the opportunity to participate in the primary dealer credit facility for U.S. primary dealer subsidiaries of foreign banks. Moreover, the potential for funding disruption did not disappear with the waning of the global financial crisis. In 2011, for example, as concerns about the Eurozone rose, U.S. money market funds suddenly pulled back their lending to large Euro area banks, reducing lending to those firms by roughly $200 billion over the course of just 4 months. While there has been some reduction in operations and some changes in funding patterns by foreign banking organizations in the U.S. since the crisis, particularly by European firms reacting to Eurozone financial stress, some basic circumstances have not changed. 10 foreign banks now account for more than 2/3 of foreign bank third-party assets held in the United States. That's up from 40% in 1995. And while the largest U.S. operations of foreign banks do not approach the size of our largest domestic financial institutions, it is striking that there are 23 foreign banks with assets in the United States of at least $50 billion. That's the threshold established by the Dodd-Frank Act for special prudential measures for domestic firms, compared with 25 U.S. firms. Most notably, perhaps, 5 of the top 10 U.S. broker-dealers are owned by foreign banks. Like their U.S.-owned counterparts, large foreign-owned U.S. broker-dealers were highly leveraged in the years leading up to the crisis. Their reliance on short-term funding also increased, with much of the expansion of both U.S.-owned and foreign-owned U.S. broker-dealer activities attributable to the growth in secured funding markets during the last 15 years. Finally, we should note that one of the fundamental elements of our current approach, our ability as host supervisors to rely on the foreign bank as a source of strength to its U.S. operations, has come into question in the wake of the crisis. The likelihood that some home country governments of significant international firms will backstop their bank's foreign operations in a crisis appears to have diminished. It also appears that constraints have been placed on the ability of the home offices of some large international banks to provide support to their foreign operations. The motivations behind these actions are not hard to understand and appreciate, but they do affect the supervisory terrain for host countries such as the United States. Now, in reaction to all of this and the crisis itself, important changes have been made to strengthen international regulatory standards. The Basel III capital and liquidity frameworks are big improvements, and the proposed capital surcharges for systemically important firms will be another important step forward. But these reforms are primarily directed at the consolidated level, with little attention to vulnerabilities posed by internationally active banks in host markets. The risks associated with large intra-group funding flows have remained largely unaddressed. Managing international regulatory initiatives also has become more difficult as the number of complex items on the agenda has increased. And despite continued work by the Financial Stability Board, challenges to cross-border resolution are likely to remain significant. For the foreseeable future, then, our regulatory system must recognize that while internationally active banks live globally, they may well die locally. Now, quite apart from the need to act pragmatically under the circumstances, it is not clear that we should aim toward extensive harmonization of national regulatory practices related to foreign banking organizations. The nature and extent of foreign banking activities vary substantially across national markets, suggesting that regulatory responses might best vary as well. For instance, the importance of the US dollar in many international transactions can motivate foreign banks to use their US operations to raise dollar funding for their international operations, potentially creating vulnerabilities. A model such as that is unlikely to prevail in most other host financial markets around the world. Indeed, in response to financial stability risks highlighted during the crisis, ongoing challenges associated with the resolution of large firms, and the limitations of the international reform agenda, several national authorities have already introduced their own policies to fortify the resources of internationally active banks within their geographic boundaries. Regulators in the United Kingdom, for example, have increased requirements for liquidity to cover local operations of domestic and foreign banks. They've set stricter rules around intra-group exposures of UK banks to foreign subsidiaries and moved to ring-fence home country retail operations. Swiss authorities have explicitly prioritized the domestic systemically important operations of their large internationally active firms in resolution. Here in the United States, Congress has instructed the Federal Reserve to implement enhanced prudential standards for large banks, including large foreign banks. In addition, the Dodd-Frank Act removed the exemption from bank holding company capital requirements that had been granted administratively by the Federal Reserve in 2001. This was an exemption for foreign banking operations in the US. This change, the 2010 Dodd-Frank change, was clearly intended to strengthen the capital regime applied to the US operations of foreign banks. However, some large foreign banks have restructured their US operations to minimize the impact of this regulatory change. So, as has been the case in the past, we need to adjust the regulatory requirements for foreign banks in response to changes in the nature of their activities in the United States, the risks attendant to those changes, and instructions from Congress in new statutory provisions. We should chart a middle course, not moving to a fully territorial model of foreign bank regulation, but instead making targeted adjustments to address the risks I have identified. In basic terms, I think three such adjustments are desirable. First, a more uniform structure should be required for the largest US operations of foreign banks. Specifically, that these firms establish a top-tier US Intermediate Holding Company, or IHC, over all US bank and non-bank subsidiaries. An IHC would make application of enhanced prudential supervision more consistent across foreign banks and reduce the ability of foreign banks to avoid US consolidated capital regulations. Because US branches and agencies are part of the foreign parent bank, they would not be included in the IHC. However, they would be subject to the activity restrictions applicable to branches and agencies today, as well as to some liquidity measures that I'll mention in a moment. Second, the same capital rules applicable to US bank holding companies should apply to the intermediate holding companies of foreign banks in the US. These rules have been reshaped to counteract the risks to the US financial system revealed by the crisis and should be implemented consistently across all firms that engage in similar activities. Also, other enhanced prudential standards required by the Dodd-Frank Act, stress testing requirements, risk management requirements, single counterparty credit limits, and early remediation requirements, should be applied to the US operations of large foreign banks in a manner consistent with the board's domestic proposal. Third, there should be liquidity standards for large US operations of foreign banks. Standards are needed to increase the liquidity resiliency of these operations during times of stress and to reduce the threat of destabilizing runs as dollar funding channels dry up and short-term debt cannot be rolled over. For IHCs, the standards should be broadly consistent with the standards the Federal Reserve has proposed for large domestic bank holding companies, pending final adoption and phase-in of quantitative liquidity requirements by the Basel Committee. That is, they should be designed to ensure that in stress circumstances, the U.S. operations have enough high-quality liquid assets to meet expected net outflows in the short term. There should also be liquidity standards for foreign bank and agency networks in the United States, although they may be less stringent in recognition of the integration of branches and agencies into the global bank as a whole. By imposing a more standardized regulatory structure on the U.S. operations of foreign banks, we can ensure that enhanced prudential standards are applied consistently across foreign banks and in comparable ways between U.S. banking organizations and foreign banking organizations. As with domestic firms subject to enhanced prudential standards, the Federal Reserve would work to ensure that the new regime is minimally disruptive through transition periods and other means. An IHC structure would help the Federal Reserve implement a consistent supervisory program across large foreign banks. The IHC would also help mitigate resolution difficulties by providing U.S. regulators with one consolidated U.S. legal entity to place into receivership. Branches and agencies would remain separate, but all other entities would be included. Further, an IHC structure would facilitate a consistent U.S. capital regime for bank and non-bank activities of foreign institutions under the IHC, similar to the approach taken in some other jurisdictions. Now, some observers will, I am sure, ask if it is necessary to depart from the prevailing firm-by-firm approach to foreign banking regulation and supervision and to adopt generally applicable requirements in implementing the Dodd-Frank Enhanced Prudential Standards. It is difficult to see how reliance on this approach can be effective in addressing risks to U.S. financial stability, at least in the absence of extraterritorial application of our own standards and supervision, and perhaps not even then. In fact, such an approach might result in the worst of both worlds, an ongoing intrusiveness into the consolidated supervision of foreign banks by their home country regulators without the ultimate ability to evaluate those banks comprehensively or to direct changes in a parent bank's practices necessary to mitigate risks in the United States. It is important to note that while the reforms I have described today contain some elements that are more territorial than our current approach, they do not represent a complete departure from prior practice. This enhanced approach would allow foreign banks to continue to operate branches in the United States and would generally allow branches to meet comparable capital requirements at the consolidated level. Similarly, this approach would not impose a cap on intragroup flows, thereby allowing foreign banks in sound financial condition to continue to obtain U.S. dollar funding for their global operations through their U.S. entities. It would instead provide an incentive to term out this funding so as to reduce the risk of runs. Requiring additional local capital and liquidity buffers, like any prudential regulation, may incrementally increase cost and reduce flexibility of internationally active banks that manage their capital and liquidity on a centralized basis. However, managing liquidity and capital on a local basis can have benefits not just for financial stability directly, but also for firms themselves. During the crisis, the more decentralized global banks relied somewhat less on cross-currency funding and were less exposed to disruptions in international wholesale funding and foreign exchange swap markets than the more centralized banks. The imperative for change in our foreign bank regulation is clear, and indeed mandated by Dodd-Frank. Now, of course, I have provided this afternoon only an outline of the three key measures that will best navigate the middle course I have suggested. The all-important details are under discussion at the board, and I anticipate that in the coming weeks we'll complete our work and issue a notice of proposed rulemaking that will elaborate the basic approach I have foreshadowed.